Welcome, everybody. I think we probably have a few more joining us, but we're going to go ahead and get started for those of you that were on time. My name is Megan Ware with Utah Manufacturers Association. I am the Director of Workforce Development. With me today, I have Craig Paulson from Altura Financial, and then I have Wayne Erickson from Transamerica. Today, we just want to discuss a little bit about the Utah Manufacturers Association MEP 401k program that we run. So we're just going to go ahead and jump right into it. So just a little bit more for those of you that are new to Utah Manufacturers Association, or UMA. We are an association, obviously, for manufacturers. We were founded in 1905, and we are the leading trade association for manufacturing in Utah. We have a couple different arms of our association. We have a full-time lobbyist that lobbies for manufacturers at the legislature each year. That is Todd Bingham, our president and CEO. And then we also have other pieces of it. We offer safety training, we offer other training, and then we are, with my role, going to be really delving a lot into workforce issues, such as benefits, retention, and those type of things. So Altura and Transamerica are partners in this MEP 401k. When we started on this endeavor, we really vetted to find people that would really meet the needs of the manufacturers, as well as people that had experience running these type of programs. So Craig is our investment advisor, and he is with Alternative Financial, and he is really, when you do get into this, you will work with Craig a lot as you get deeper into the program. And then Wayne Erickson is with Transamerica, which we're really lucky because it is a national company, but they have a presence here in Utah, and we do have, Wayne is local, and he is here to answer your questions and meet your needs, and Transamerica is the record keeper for the program.
Okay, thanks.
Take it away, Craig.
Appreciate you including us today in this webinar. And, you know, as we put together this presentation, you know, I was thinking about, you know, what is currently, you know, what's the environment that these manufacturers are in as decision makers, and some of the things that I think that are on people's minds as I've been talking to them are, first, you know, we're living in a strange time, right? There's all kinds of geopolitical things going on right now and a lot of uncertainties. And so I think that's on people's mind, as well as, you know, as I talk to business owners and executives, HR people, is there, you know, because of the unemployment and how low it is, you know, they're talking to me about how do we enhance our benefits to retain employees and recruit them. That's on people's minds, as well as, you know, because of the uncertainty, we want to make sure that our costs are contained and we're being efficient with what we're doing and with our operations. So I believe that's kind of the environment we're in. Then I also was thinking, you know, why are people going to be attending this webinar? You know, what are they thinking about? And when it comes to your retirement plan, I'm guessing that most of you are attending this because you're wanting to maximize the value that you're receiving from your plan. Or maybe you're thinking about, you know, how do I determine that value? Or am I receiving the best value? Or if you don't have a 401k, you might be thinking about starting up a plan. Because I think, you know, Megan, we were talking about this earlier, that employees, when it comes to benefits or what they're looking for from their employer, number one, it's health insurance. Number two, it's the 401k.
Absolutely.
And then number three, we were talking about PTO.
PTO and work flexibility.
Yeah, work flexibility.
Yes.
So we were both on the same page with that. So 401k being number two, it's a big deal. And I get a lot of calls, it seems like once a week, with employers saying, hey, what do I do to start up a plan? Or what do I do to make my plan more attractive, because maybe they have one and they're wondering what to do with the match and so forth. You probably get the same conversations.
To jump in on that, I think in today's environment, it's so common. We were looking at more of a national perspective, but on a national perspective at Transamerica, we noticed the number of new plans that was started in 2021 compared to 2020 was up almost 50% year over year, which was our biggest spike in plans of the last decade. So due to the current environment, to attract and retain key employees, companies all across the nation are going to set up plans that maybe haven't. And there's been some legislation change to make it easier, which we get into a little bit as well.
Yeah. So some of the roadblocks that I identified that employers have when it comes to maximizing their retirement plans are, I think, number one, it's a lack of knowledge. Wayne and I meet with individuals and companies all of the time, and it's interesting how we realize that they don't even understand their own plans. They don't understand how much they're paying or what value they're getting for what they're paying.
Yeah, and if I can jump in, and I think the biggest reason for that, I'll put blame on myself because I'm part of the industry, but the industry has done a horrible job of making everything succinct and similar. Every fee disclosure you look at is going to be different, and every company calls it a different item, and there's so many acronyms in our industry, and because of that, it is very hard to understand and to grasp. So that's, as an industry, I wish we would do better. That's something I'm hoping the industry improves upon.
Well, and as an advisor, I'm part of that too, and can better educate my clients and prospects. But, so there's a roadblock of knowing whether you have a good value or not because you don't understand how you're being charged. Some of those fees come in the form of asset-based charges. Those are the ones that are trickiest, I think, to figure out because they're baked in. And not that they're intentionally hidden, it's just a different way of charging, and they can be difficult to understand. Then you have the billed charges, which are more easy because you get a bill, you see it, it's more transparent. Then also, I don't believe many of the 401k sponsors out there understand their own fiduciary responsibilities, and with that fiduciary responsibility comes potential liability. And so if they don't understand that, then maybe they don't even know they have a roadblock, with the value they're getting or not getting. But some of those potential liabilities are, is the plan being administered, per the plan document? The Department of Labor has, I believe it's an employee now living in the state of Utah. So audits are on the rise in Utah. And oftentimes, those auditors will find out that the plan document says, hey, commissions should be included as part of your withholdings or part of your contributions, but they're not being withheld from the paycheck, or vice versa, right? And so that would be an issue that plan would have, and as a plan sponsor, they have a liability there, and fines, right? The DOL can fine big time. So then there's also some responsibility when it comes to the investment lineup. If you have a current 401k right now, you should have a process for picking investments or making the investment selections for your menu. So we're not talking about the individual participants choosing the plan or picking investments. I'm talking about you as a plan sponsor picking the lineup. There's a responsibility there to make sure you have a process, perhaps an investment committee that reviews those investments, and a process for making sure they're suitable for that lineup. So that's a responsibility that some plan sponsors may think, oh, I have an investment advisor for that, but the investment advisor's role is truly just to help guide you. It's not his or her ultimate responsibility. It's the plan sponsors. So that is something that you should be doing, or hire someone to help you with that. And then there's also, you need to be doing plan reviews on a regular basis. With our clients, regular means, annually. But the Department of Labor just says on a regular basis. So whatever works best for you on a regular. And then some plans, if they're large enough, if you have over 100 participants, you need to have an annual audit. And then you also have the responsibility of filing a 5500. And your current TPA may prepare that, but ultimately if you have a single employer plan, the trustee is signing that document. So much like you have an accountant that may prepare your personal tax return, you're still signing it as the individual, and the 401k works the same way. So there's that responsibility that you're signing off on the 5500 and saying it's working the way it should be. So we'll get into multiple employer plans and how it can help a little bit more with some of those, how you can outsource some of that responsibility. So overcoming this lack of knowledge roadblock, you can request a 408B2 plan fee disclosure to try to understand those fees. But as you said, they're not still.
It's
Very
not very
confusing.
easy.
No.
once
Very
you get
confusing.
that.
Yeah, so as prospects and clients have given those to me, you do have to do some calculations because sometimes it's cryptic, and we're in the business, so we know how to interpret those 408B2 fee plan disclosure statements. So I would advise that you just consult with your own advisor or with a professional that understands those, so you can dive into the actual fees and understand how they're working. And then the same comes with the fiduciary responsibilities. You may not understand what those are, but you can consult, with someone like Wayne or myself or your own advisor or record keeper to make sure you understand what your responsibilities are. But where we see the most red flags are, like I mentioned before, where the plan's not being administered per the plan document. That's where the DOL will come in and fine employers. And the second one is there's no plan for monitoring the investments. And that's where you may have a plan participant complain or an employee that's saying, hey, how come you have this particular investment, and you've got to have some backing or some support that shows why. So anyway, the multiple employer plans are becoming more and more popular, and that's where you can overcome some of these roadblocks, and they're becoming more and more popular, and that's due to the Secure Act of 2020. Transamerica, you guys have been administering these multiple employer plans for years, but I know in my practice that's where we've seen the most growth is within these pooled plans, and I think how's it been for you?
Yeah, we've been running pooled employer plans and had a dedicated platform for over 20 years now. So it's been a place where we've really tried to create some expertise in that. But this last year, we did more in sales. We did about $2.5 billion in total sales in multiple employer plans, by far our largest growth segment and our number one year ever. So due to those legislation changes of the Secure Act, getting rid of the bad apple rule, and some of the credits that are out there for new companies looking to start up, it was definitely the largest growth we've seen in the multiple employer plan industry-wide ever. So there's a lot of excitement in this area.
Yeah. So we'll get into some of that, but just I tried to draw an analogy to oversimplify this probably, but what I thought of is you've got single employer plans that many of you probably have versus this multiple employer plan concept. And what I thought of is it's so easy to break a single pencil. So my 8-year-old daughter could probably get a pencil and snap it pretty easily, and it's not very strong. However, if you stack 12 pencils together, Wayne, who's an athletic, strong guy, he wouldn't even be able to break 12 pencils grouped together. So just know, if there's one takeaway, that 401k plans are much stronger when you have plans pooled together and you share in the responsibility and you're outsourcing risk and having other people take care of that. So just think, hopefully today the takeaway will be you're shifting from this single employer mindset to seeing the advantages of having a multiple employer plan.
Okay. Thanks, Greg. And we'll go a little bit over additionally some of those benefits of the multiple employer plan. And where we're going to start is let's just go over some of the differences. So kind of that's the first thing we'll do is go over kind of our agenda here. Single versus multiple employer plans. We'll talk a little bit about administrative support as well. Just trying to make that as easy as possible, touch on the fiduciary investments, go on some education, and wrap up with pricing. But when we talk about single employer plans, and for companies out there that are already doing this today, you're familiar with the fact you are the plan sponsor, you are the fiduciary. So there's going to be responsibilities that you have to do, and there's going to be just items that cost and extra work. And as we put on here, as I know Craig alluded earlier, if you're a single employer plan and you have over 100 employees, right around there, you're going to get to a point where you will have to do an audit. Not only does this cost money, we'll get into that a little bit, Pat, but I wanted Megan to talk a little bit because she's been on both sides here and lived this.
I have. I was with a company and we hit that magic number and had to go through our first audit, and it is complicated. It is laborious. We had also changed our payroll provider during the middle of the year, and that just brought so many issues that you just couldn't have foreseen. And I can honestly say it took a solid month of almost my undedicated time to get this audit across the finish line. And I don't know that that was maybe the best use of that much of my time. I mean, that took the price of the audit, which I think was right around $9,000. And then a month of salary added to that. It was stressful. I mean, I'm not going to lie. It was very stressful.
Yeah. Well, thanks. That, you can hear somebody who's kind of lived with that exactly. So as you know, each single employer plan would have to do their audit once they cross over 100 employees. And then as well, plan design, and then there's education as well. So with a multiple employer plan, we are able to pool plans together to create economies of scale. And because of that, we can also hire and bring in groups who will act as fiduciaries to help reduce your administration and your fiduciary responsibilities. So in the Utah Manufacturing Association plan, we are outsourcing as much as the fiduciary responsibility that's legally allowed today. So as a plan sponsor, yeah, you're still a plan sponsor and you're electing to have a plan, but all you have to do at that point is just make sure the vendors are doing what you've asked, because you have outsourced that responsibility. So that will create a lot of relief from trustee duties we'll get into earlier. And as we've talked about, that means no audit. So to be clear, there is an audit being done. The audit's being done at the multiple employer plan level. So it's happening. It's just the auditors aren't coming to your office. You're not the one paying the fee for it. It's included in our overall value proposition here. And one of the other things that come up, we will do custom plan design, and then your web access. Sometimes people think I do a multiple employer plan, like maybe I'll lose some of the access I have today with my 401k plan, and that's not the case. So if you have a 401k plan today and you're logging into your 401k record keeper site, with the multiple employer plan, you will still have your individual login to your site, where you're going to log in and be able to view that and kind of see. And then, every company in it will have their own login. So you're seeing just your information, but not anybody else's information.
Yeah, and so I guess, back to earlier in the presentation, one thing I was thinking about, where employers are most vulnerable, or where plan sponsors are most vulnerable, is with the administration of the plan, right? Making sure that it's being administered per the plan document. That's where they're going to have some vulnerability with the Department of Labor. And then the second, I think, most vulnerable position they're in is managing the investments, right? And making sure there's a process to document, why they've chosen the investments and why they, have them in the lineup. And those are both those responsibilities, or those potential liabilities, are outsourced by Mesero for the investment selection and monitoring, and MBS for the administrative fiduciaries.
Yeah,
So no, I just think that's where this multiple employer plan really shines. In addition to the audit that we talked about and having less hassle and whatnot, because they can just remove themselves from that. But
yeah,
you're some strength.
You're right. We're getting the investment piece will be completely removed from plan sponsors' plate, as well as like the administrative items there. The other thing that I will kind of touch on here is that custom plan design. A common misunderstanding of this industry is that a lot of people think if you go into a pooled plan or a multiple employer plan like we have with the UMA, that you have to have a cookie cutter plan design, meaning that everybody needs to have the same. Like everybody has to maybe be safe harbor or the same vesting or profit sharing or not. And that is not the case. There are some companies out there where it's basically a limitation of that record keeping platform, but it's no way a ERISA rule. So at Transamerica, our record keeping system is set up where each individual adopter has their own plan design. So a company can come in and say, hey, we want to do a yearly profit sharing. Someone else will say, hey, we want to do a match. Someone else can come in and say, hey, we're just going to make a yearly contribution of 2%, whatever it is.
Or no match, right?
Yeah, or no. We just want our employees to put their own money in, but right now the company can't make a contribution. So all of that is completely flexible on an individual employer basis, which is very key to kind of get into.
And just a quick question. This is something that just because you set it up on the front side, that doesn't mean down the road you can't make changes. Maybe they start off with a 2% match because that's all a company feels like they can afford, but they have a great year and they feel like for retention that maybe a 5% match. And that's something that's fairly easily changed.
Absolutely, yeah. Most plan design items can be changed at any point in time. There's a few limitations on maybe like some safe harbor contributions that have to be changed annually, but actually with the Secure Act, they have went back and made it to where those are easier to change than they were in the past. So I'm doing more mid-year changes on safe harbor plans than we've ever done. So it is absolutely flexible, and as your business changes, and we also build in them to be flexible. Like almost every company that comes into the UMA multiple employer plan, we put a discretionary profit sharing in the standard documents. That doesn't mean you have to do profit sharing, but it's already in that document. So if any time at the end of a year in your tax time, you're like, oh man, I'd really like some deductions, it's already built into that plan to where you could do a profit share to limit your tax liability if that was advantageous. So we'll get a little bit into administration offloading. As we talked about, time is money. I loved what Megan said earlier on the audit, because it's one thing, a lot of times we think of the audit, we do get, yeah, my audit was $9,000 or $10,000, whatever that dollar amount is. But calculating in your employee's time, that is absolutely you need to do when you kind of consider the overall cost. So anything to bring down this operational burden will definitely help. With the plan, when it gets real into administration, what you'll still have to do is you have to get the data over to, Transamerica, the record keeper in this example, and that's through your payroll feed. So there is going to be a payroll either upload, or if you work with a larger payroll company, most of those we have integration built where we can set it up to where it happens automatically and it's very seamless for you. But items that companies are probably doing today, or this is a really important item, a lot of times companies don't realize that they need to do this until they set up a plan. But these are all kind of things you have to do. Like those investment reviews we talked about, that's taken off your plate. But just if an employee wants to do a loan, typically that's something that they have to get the employer to sign off on. Not in the UMA, that's going to be handled at the master level. As well as when somebody terminates and now they want to roll that account over to their new employer or do an IRA or whatever they're doing with it, that's not going to go back to the HR person of that company. That's going to be done at the multiple employer plan level. As well as there's just a bunch of legal disclosures that have to be mailed out each and every year for 401k plans. The industry forces us to just bombard people with a bunch of notices, and those notices also will be sent out automatically by the association. It's not each employer having to send those out. And then, as we talked about, there's no longer a need to do an individual 5,500 because that 5,500 is being done at the MEP level without you having to sign off and do that. So there's just a lot of tasks that we can outsource.
As you're talking through that, Wayne, I was just reflecting back to when Altura Benefits or Altura Financial Advisors had our own single employer plan. And granted, we only have 10 employees, right? But at the end of the year, I was, the TPA would prepare the 5,500, but then send it to me. I'd still have to take the time to go in to the DO website, electronically sign it, and submit it. Not a huge task, but still a responsibility I had to take care of. And then the TPA would prepare the required notices that you were just talking about. And then I would have to distribute those, or they would be prepared and sit in my inbox that would get covered. And so, again, simple tasks, but at the same time, not maybe my biggest priority.
Yes.
And then even with new hires, when I have a new hire come in, I'd have to remember, it's been, she's met her new hire waiting period. I need to make sure she gets her packet and enrollment guide. With the multiple employer plan, it's made my life so much easier as a business owner just to not even worry about that anymore. I don't have to sign the 5,500 at the end of the year when I'm worried about getting Christmas gifts for my kids, or I guess my wife's really doing that. Good thing she's not hearing this, so I should take credit for that. But anyway, and then also like the loans and distributions, I just think, I see these CFOs or HR directors that are having to sign off on those. Again, not huge things to do, but when you have other bigger priorities, that's the last thing you really want to do. So it's so nice now that we're part of this multiple employer plan that someone else is taking care of that. And MBS is signing off on the documents, and Transamerica is sending out all the notices and enrollment kits. It makes my life so much better.
Yeah. Go ahead.
I just say I don't know that people also realize the fees and the fines that can come when you don't get those notices out. It's a big deal. You need to document it. And I think, I just think of so many HR professionals I've met that are maybe working for a smaller company, and this HR professional is wearing
so many hats.
And it's like you're just constantly putting out the fire. And so these are the type of things that just fall down, and then all of a sudden you're in compliance trouble. And so I think this is just such an ideal setup really for any company, but those companies that, well, everyone's understaffed right now, so that's not even it. But those companies that are at that 100 level or below, I mean, bigger too, ideally, but there's just so much work involved with keeping it going, just keeping the ship going.
Yeah, and I think, Megan, you touched on a very interesting point there is that it's not only just doing it and getting it out, but it's documenting it, right? If you get audited for any reason, like we said, there's a Utah auditor now, they come back and say, show us how you sent out your eligibility notices for this new hire class you did 4 years ago. I don't think many companies would be able to pull that out and say, this is how we distributed it, whether we handed it out, whether we mailed it. And that's what's nice about this program is that is documented and housed at Transamerica, and the auditor would come to us and we'd be the one to document that and hold it for all the years. Because it's one thing to get it out. I think it's more difficult and probably less likely to be done to have that, basically that trail of how to have it and the documented of it all. With fiduciary management, as we talked about, we will try to outsource as much as that as is possible. We have a bunch of different parties, as Craig mentioned, that are going to kind of step in and help with the fiduciary control and just make it to where you will be as responsible for as little as possible. And the reason why we keep kind of coming up with fiduciary responsibility is it is something that is very important that when you do these plans and you set it up, everybody sets up the plan to be in their employee's best interest, and it's an employee benefit. But all too often what happens is if it's not reviewed and checked upon on an ongoing basis, it can get to where maybe it's out of whack and it's not having the benefit that it was intended to, or it's just not competitive in the marketplace. And what's interesting about these is like most of the items as a company, when you sit down and kind of look about, like if you go negotiate your audit fee, the company's writing the check for that, right? The company's paying for the audit. Where in these 401k plans, the company negotiates the rates, but it's actually the individuals that's going to be paying for it. And they're the ones paying for it inside of their own investment account. So that's why I think it's so important to, just as Craig said, the DOL will come out and say like, hey, it's every so often or at the right time. The same comes with benchmarking your plan. They recommend to do that at least 2 to 3 years is what they say. So if you haven't done a competitive look on your plan, please reach out to Craig and I. That's definitely one of your fiduciary responsibilities. We can help you with that. If you just look at this and put it in your folder, at least you can say you have competitively benchmarked your plan. And we can give you an idea of how your plan looks on fees overall. Because remember, like I said, it's your employees that are paying it. You're negotiating it, but your employees are paying it. So it's just, it is something in your due diligence you need to do to make sure that it's competitive.
Well, sorry. Yeah. And I mean, employees will ask.
Yes.
And employees will inquire. Not every employee, but I assure you, you will have that couple that they will hammer you on those fees and they want to understand what their money is doing. And so if you can't explain it, you start looking dumb. And it's hard to explain.
It is. As we talked about. Yeah. So, and then investment flexibility. Craig mentioned this is one of the great benefits is we will be able to take the investment mix completely off of your plate. So that's being handled. Like I said, we have a fiduciary company called Mesero that's going to step in and help out. And then Craig's and his company, Altura Benefits, gets a kind of final say in working with Mesero. But we will have what's called a best-in-class open architecture lineup available. So if any of your participants are more familiar with investment accounts, they can come in and build their own portfolio based on these investment options, which we have basically went over and done our due diligence to make sure they are prudent investment options for an institutional retirement plan. But
yeah, and so something I thought of is, and that's also be done at the plan level, right, with the association.
Yes.
So these adopting members or participants in the plan or employers are completely removed from that responsibility altogether.
Yeah, and ideally that's the benefit too, is that you are completely removed from it. So that way you are never brought in that anyway you had any say or control over it. So that is by design. You're not going to be brought into any of the investment reviews. Or if you're doing a single employer plan, you need to be involved in those investment reviews. But with participants, what we see is a lot of times people get enrolled in retirement plans and they go and they choose their investments. And unfortunately, a lot of people don't come back and make changes. As you can see on this stat here, only 6% of participants go in and change their account balance once it's been set. And then once they set up how they want your future contributions invested with each payroll, only 3.6% of participants come back and make changes there. So as you can see, it's something that people generally put on a autopilot or they forget about it, right? Life gets busy. And honestly, in 401k, that's a good thing. We don't want people coming in and changing their balances and being overly sensitive to investment changes like we're seeing today. But we do want investments to change because our risk tolerance change. And as we all know, as when we're younger, we should be taking more risk. But as we get older, we need to start to decrease that risk in a more prudent nature. So we do have a default investment option in the UMA plan where if a participant does not go in to make a choice, they will be put into what's called a target date fund. It does just that. It's going to start off more aggressive, But then over time, it's going to get more and more conservative. And if you're a career changer coming in and you start later in your career, because of your age, you're going to be put into a more conservative portfolio right away. Now, anybody can go opt out of this and build their own portfolio like we talked about, but it's good to have a target date option in there that's basically going off of the age and making it on autopilot so people do forget about it, which, as the numbers have showed us, most people do. And the other benefit of our fund it will be an index option, so it is a very low cost, like the BlackRock index funds. These are going to come in at 7 basis points or 0.7%. So extremely low cost as we get more into that as well. Also, Transamerica, we have a lot of education materials, webinars that we can leverage for your company to make sure you're getting the most up-to-date information and keeping your employees engaged in their retirement account. Also, I want to be very clear, we have a lot of Spanish capabilities as well. So if you have retirement plan and your company has Spanish speakers and you've maybe had a gap in not being able to provide them materials in Spanish, at Transamerica, we can provide all notices, marketing in Spanish. On our website, can have a toggle between Spanish and English. Our mobile app right now is English, but we have a Spanish version that's setting to come out like in the next quarter. So all of that is going to get to where it's very easily done in Spanish. But just want you to know, you got a lot of options to help you out with education.
Well, and I've been with several record keepers, and I can honestly say that I think that Transamerica's education is very robust, and I like that it has very detailed information for that first time. Those young employees, this is their first time they're saving, their first 401k. But then they also have, for those really advanced people in your organization, say your engineers that research everything, they're going to have a lot of questions and a lot of detailed questions, and they have that level too. So I like the variety that there's a lot there.
That's true. For sure, their tools are great.
Yeah, the tools they're designed to be simple, intuitive for people just starting off, but then people want to get more into the weeds. There's a lot there. Yeah. And as Craig talked about this great pencil analogy, and we'll talk now about kind of the economies of scale. What does pricing look like with the Utah Manufacturing Plan, where we will be as transparent as we can be with fees and then also comparing. So like we said, we think the main benefits of this plan, to be crystal clear, are going to be offloading your administrative duties and then offloading your fiduciary responsibilities. Like that's the reason why most companies have joined that have came into this multiple employer plan. That has definitely been the reason. But fees is also a part of it as well. So if we kind of get talking into fees, there's going to be basically a one-time document fee of $750. That's what the company will pay. And then when it gets into participant fees, each participant that has a balance in the plan will have $36 annually deducted from their account on a quarterly basis. So $36 annually deducted quarterly. And then our expense ratio of our funds, the average is going to be 26. But as I mentioned earlier, the default fund is actually only going to be 0.07. So depending, like I said, whether they go out and build their own portfolio or go with the default, if you have a lot of employees that stay with the default, your average would be lower. And then we have what's called a contract asset charge, which is basically going to take Transamerica's fees, Altura's fees. It's going to pay for kind of that audit we talked about earlier. And that's all going to be grouped in. And depending on the size of your company, that can go anywhere from right about 0.5% up to about 1.7. We can go over in depth with each company, kind of where you fit in that spectrum and really get some in-depth analogies. But keep in mind, when we talk about that pricing, the benefit here is we have over 20 adopters in the Utah Multiple Plan and for about 25 million. So you're getting pricing based off that level versus, if you're a company that's looking at to go start your own, it can be pretty expensive to start in year one. Or, if a company that's had a plan and you're growing a little bit, take advantage of pricing it with 25 million in assets versus just yourself to gain those economies of scale.
Yeah, it's huge benefits. And also what we've seen in the last 2 years since this plan has just exploded in size is that the pricing's actually come down for all adopting companies. Each individual adopting group will hit different benchmarks and their pricing comes down. Yep. So that it helps each individual company as their plan grows. But also as the plan grows as a whole, it brings the pricing down for everyone.
Yeah, and I should have mentioned this up front. We definitely do want to take some time for Q&A. So if anybody has a question, if you want to type that into the chat, please do, and we will be more than...
Okay.
We have one. Okay, perfect.
From Anthony, bummed because webinar is breaking up while talking about the fees.
Oh.
All right. I guess that is on me. I will lean in and go back over the fees here. So yeah, like on a per document fee, the company fee will be a one-time fee of $750 for the company to pay. And then you can see here, we do have participant fees of $36 annual for every participant in the account. And then the expense ratio, as you can see here, will be 0.26, and your contract asset charge will be somewhere between there, depending on the size of the company. So if you would like to get a exact quote for your company, or even to do a cost comparison of your existing plan, please reach out, and that's something that Craig and I can help you with.
Yeah, and I would suggest you do that, because you have nothing to lose by at least having us look at it. And if anything, even if you don't go with it, as you said, Wayne, they can put a quote, a comparison in their file, and they can check off the mark that they benchmarked their plan.
Yep.
And the DOL will like that.
Yes, that's something great to have in your folder. Absolutely.
Agreed.
Anthony typed again. He said, I would love a cost comparison of your plan.
Wonderful. Anthony, if you will just provide your information, we will reach out to you with the information you need to get that set up.
Yeah, we'd love to talk to you soon, Anthony.
And I just wanted to speak. I know I keep going back to the audit, but I think really you get into that. I think 5,000 is a very low.
Oh, yeah.
I think it's probably more like 8 to 10, maybe even 12. Just the upfront cost of it, and then there is a lot you have to provide. Now, with the MEP audit, just as we're actually currently going through that right now. There is still some items that you as the adoptees will have to provide. Yeah. But these are very, very simple. It's a couple of payroll reports, and then there will be, they'll give you some samples, and there's some information you have to pull on them. But this is honestly something that will maybe take you an hour to an hour and a half versus
Days.
40, 80,
Yeah. 120
hours. And you won't have the pressure of that deadline, finding an auditor that you may or may not trust. And so there's that. And then with the MBS, the compliance piece, I actually worked with them on my second year on the audit, our second year audit, and it was night and day. It was so much easier because they had our back on all of those compliance pieces. And, Transamerica, we had the records of all of the notices going out. And so I think just don't underestimate how much that piece of it is. And I think we talked about earlier, Wayne, if you are a company that you're not satisfied with your 401k plan, maybe you're a small company and you got the best you could get, which I well know isn't great. There's not a lot of options. And you're maybe getting to that 75 number and thinking about making a change. Make a change before you hit that 100 number so that you don't have to do your audit, even if you do change.
No, yeah, Megan, that's a great point, because you have to, if you cross that number during the year, you would have to do the first audit on yourself, and then the second year, if you join the MEP, you could kind of get rid of it. So you have to actually join the multiple employer plan the year before you become audit eligible, not the year you become audit eligible. But as Megan mentioned earlier, just that everybody right now, it's hard to find people. Everybody's understaffed. Like, I would look at this as an opportunity between not just the audit, but the loan items we have talked about, and approving all the notices and your distributions and tracking eligibility. Like, if you're looking at a way to make life more efficient for your human resource department, this is a way to do it. This is a way to take something off their plate when I know normally we're putting more and more on their plate. So think of it as that way. And like I said, for most companies that join, like I said, the cost savings are great. And someone's like, but most people join because they want to take those items off of their human resources plate and free them up to do other activities.
Yeah, and as we were talking this morning, Megan, too, you had mentioned that you've gone through a transition from one record keeper to another. And how was that experience?
Yes, we actually transitioned from another company to Transamerica. And we were at the time 350 employees. Of course, there were a few hiccups, but I can say, we met with Transamerica weekly. We had a weekly phone call for probably 3 or 4 months, and really, really, they walked us through the transition. They held our hand, and we didn't have really that many issues. A few of them were actually just self-induced because we went to an auto enroll, which it complicates things a little bit. But
it's good.
It's good. It's an awesome feature, but they were so great. They came out, they educated, and I think overall our employee population was incredibly pleased with the outcome and then the forthcoming returns that were happening with Transamerica.
Yeah,
and the
and
plan.
from my perspective, because I'm involved with many of those meetings, is Transamerica does all the heavy lifting.
Yes,
right?
they absolutely do.
And make it as easy as possible, even though it's not a perfect process. It is, I think, much easier than what some think it might be.
Yeah,
It's
and
not terrible.
I think people think it's longer than this too. Typically, a full conversion, it's a little bit of work up front. There's a waiting period because notices have to go out and you got to
Yep.
wait. But like you're getting assets over usually within about 90 days. So it's a 3-month process, but really meetings the first 3-4 weeks, and then the last 2 to 3, and then there's like kind of a lull in the middle.
Yes.
But yeah, in 90 days, you can have a plan completely transitioned and over and take off just a lot of your plate.
Well, should we
That
wrap it up?
questions?
are we-
Wrap it up and
yeah.
We haven't had any new questions.
Okay. Well, then we're going to head and wrap it up. This was recorded, and we are going to make it available. And we will also send out an email just with kind of the information for those of you that are interested in reaching out and setting up those appointments and have some follow-up with it. So thank you so much, Craig and Wayne,
you're
for
welcome.
being here, and thank you, everyone, for attending.
All right, thanks
Megan.
for having us.